recorded. Now we're gonna proceed again with this data, and this data was time series data. Import to an Excel spreadsheet, and which is the right data, yeah. And of course, when you import as an Excel spreadsheet, the first thing that you need to take into account, like import the first row data as a variable names. So these variable names will be appeared in this data, already named, so you don't have to rename it. And apart from that, before putting data into the Stata, you have to take into account that the ID should be created before. If it's time series, there's only one ID. If it's like panel data, at least like 2 and more IDs should be created. And once the data set has been imported, then the second thing that you need to do in here is to declare whether the data set is time series or not. Like you can do like type in the TC set, given the command, or you can just go to statistics. There's a time series, setup and utilities, declare data set to be time series data. And as a time variable, we select years, and panel ID, we select ID itself. And our data, it's a yearly, because we're dealing with a yearly basis. And we just press OK. Or what you can do, you just type this command, like TC set ID years, yearly. If you don't type this yearly, it is going to be appeared automatically yearly. But if you want like your data to be daily, then you have to type it here daily, like specifying what type of data set you're just trying to import into the Stata. Once the data set is cleared, okay, there's a like standard the standard steps that should be taken in Stata. Like when you run any type of data, it's summarize the data, try to see what type of data you have. You just type sum or press enter. Like these are the data set you have it. Years, ID, domestic credit, export, FDI, GDP, military expenditure, and logarithm of GDP that we have already took the natural logarithm of GDP. And we took it the logarithm because we wanted to standardize all variables, because all the variables are in percentage except GDP. GDP was in absolute or actual numbers, so we need to convert into more standardized, into more common. And we made it like we took the logarithm of it. This is the first thing that you do it. The second thing we just said, like, let's do the simple regression analysis. Like there is one dependent variable, one independent variable. We said regress. And we were regressing, I think, was it the GDP or? Anyway, anything, like I'll say anyone like GDP, and I want to see how the domestic rate affects the GDP itself. And just 2 variables are affected. If you put first LGDP, logarithm GDP, that shows that this variable gonna be dependent variable. Second variable goes as independent. You can put as third, fourth, fifth, and fourth, and so continue. Okay, there is no any limit on that. And that will be, if you put more than 2 variables, it's going to be like multiple regression analysis. But this is like simple regression, not just one dependent, one independent variable. And we just press enter, and we come up with this data. Okay. So this is the model that we are going to discuss, that we're going to work with it. So okay, we just copy as a picture. I'm going to put it in a Word file. I want to put in a Word file because to make it a bit bigger here. So we can look at it closely here. So the first thing that I want to look here, the important parts are coefficients that I concern more. The p-values, that was really interesting for me as well, that I'm going to use it for my discussion. And of course, this part. So we're going to discuss all these things. These are very important in this table, okay? Like the standard error, the T, and confidence interval, they're two, okay, important, but once we use the p-value and the coefficient, they're more than enough to get all the necessary information to come up with a certain prediction. Okay, so first of all, when you run such a thing, when you come up with such a regression analysis, so DC and constant variable, it's an intercept. DC is has got the slope, and where our dependent variable, we can see it here. Our dependent variable is GDP. So GDP is proxy for growth, okay, for the economical growth, like how country grows. And let's say we have decided to do this regression analysis for one reason. The reason is that we want to see how domestic credit for private sector affects the GDP, the economic growth. Okay, if you think theoretically, domestic credit and economic growth, they are kind of positively related, because more money you give to the private sector, the more they start to produce goods and services, like restaurants, small enterprises, they give more production. As they give more production, that contributes to GDP. If you just remind yourself, what was the GDP? Like, what are the main components of the GDP? You remember, let me just type it here. Really just standing. So what was the main components of the GDP? Consumption plus investment plus government spending plus net export. Okay, these are the main components of the GDP that contributes mainly to make the GDP to grow. But as a main components, we are only dealing with the investment, which is domestic credit. Okay, we can include the military expenditure that we had there as a government spending, but we are not going to do that. Okay, we just put it aside. But we are now concerned about the investment only, like private sector, how the private sector contributes into the GDP. Why we need to do it from the perspective of the government? You might be interested, like, should they improve the private sector more? Should they give to the private sector more money to go and increase the GDP? Okay, you might be experiencing GDP fall, okay? Like nowadays, the China, United States, and some of the European countries, they experience a small fall in the GDP, okay? They have declared officially the economy slowed down. Now they need to improve, they need to create some stimulus to work the economy again. What they should do? Consumption, investment, government spending on net exports. What they should do? Let's start with the investment, okay? Let's improve the private sector. But we don't know whether the private sector gonna work in this country or not. So before running the regression analysis, you have to clarify yourself. What are you looking for? Do you want private sector to be improved with the purpose to increase the GDP? Yes, why not? So we did this regression analysis and we come up with the coefficients, okay? This coefficient and this. And we said that coefficients represents betas, okay? If you remember econometric model that we had it. Let me just go to the lecture notes that we had it to remind you. So this is econometric model, okay? We have it. So in here, we have the betas, okay? Beta 0 and beta 1, which are coefficients, okay? So this is the econometric model that shows by how much it will impact the dependent variable, which is this one. In our case, it's a GDP. and in what direction. So there are two types of information we can get it from the coefficient: the capacity of the impact and the direction of the impact, positively or negatively. So in this case, if we go back to our analysis here, we can see from the coefficients, they are positive numbers, okay? They are positive, which means positive impact, positive effect. So the first thing that you may conclude from this, that domestic credit has a positive impact, okay, on economic growth. But what does the constant represent? Why we need to have it?
If it stays the same, so GDP will change by
Yeah, let's say we do not change anything. We keep everything same, like fixed, ceteris and paribus. All other factors kept fixed, including the GDP. We have only one factor in here, which is domestic credit. And there are some other factors. If I write here, the econometric model for this, I will write it in the following way. So my economic model will be GDP. Can you see it from here? The other one, it's better. So GDP, the main dependent variable, equal to beta 0, the coefficient that we have it, plus beta 1 of domestic credit, and plus error term. Error term is what?
some other factors.
Some other factor, unobserved factors, okay? Unobserved disturbance. We don't know what are the factors. Okay. We include the domestic credit, and domestic credit is proxy which component? We said it's investment, okay? And we know that there are other factors that have effect on the GDP. What are those factors? Consumption, government spending, but we don't include it here. They are not here. We only deal with this. So, which means there are other factors are represented by error term, which are unobserved. So, we want to see the specifically ceteris and paribus making equal this and this to 0, like exponential, we call it like error term of the exponential mean is equal to 0. We want to see only the impact of the domestic credit on the GDP, like make it equal to coefficient 0 and the other factors to 0. We can see that the GDP will be affected by 0.008%. But the effect is really tiny, okay, very small. I'm not saying what it's significant, it's a small effect. Just 1% change, it has a really very, very small effect on the GDP. Okay, this is the case. But if you make the ceteris and paribus equaling all other things into the zero, including the GDP, your GDP will increase by better coefficient, which is 11.65%. Okay. The second thing that we have discussed, how much trustable these coefficients? Okay, they have a positive impact, we said, but by how much they're trustable? Can we trust on these numbers? To do that, we need to compare, we need to take into consideration the p-values. Like these are the p's that are given. First of all, we need to start with a constant variable, with the beta 0. Basically, we create the hypothesis, okay? Null hypothesis and alternative hypothesis, which you have already studied in your statistics. I don't know whether you took it or not. The null hypothesis says that your beta 0, the coefficient of the constant, is equal to 0, which means
it is not significant. If it happens, if you accept the null hypothesis, you say that this coefficient is not reliable. So I cannot say that this has impact. But if you fail to accept it, I mean, if you reject it, the null hypothesis, then beta coefficient is not equal to 0, which means it is statistically significant. It is reliable. So you can surely say that this has an impact on GDP. But this is our aim, okay? To reject the null hypothesis. In order to reject the null hypothesis, in order to make the coefficient reliable, the p-value should be less than 0.1, 0.5, or 10% significance levels. It should be less one of them. Okay. So we can see here, p-value in here is 0, which is we reject the null hypothesis at 0. Then we move to the domestic credit coefficient. We create another hypothesis. Now, an alternative. Same, but the better one equal to 0, better 2, sorry, my bad, better one not equal to 0. We reject the null hypothesis if the p-value is less than 1%, or 5 or 10. It is less than 1. So we reject the null and accept alternative. But remember that we never say in statistics or in econometrics accepting the alternative hypothesis. Never say that. Either you reject the null hypothesis or you don't reject the null hypothesis. Okay? When you say I reject the null hypothesis, it is already meant that you accepted the alternative. But you never say I accept it but reject it. You should only say you reject or you don't reject the null hypothesis. Okay, we have seen that both coefficients are significant, but the impact of the coefficients, the capacity by how much it affects, is very tiny here. Okay, this is very important as well. Though it's a significant, we can rely, but it has a small impact. There was a book, an article that was saying that in the United States, the company that contributes to the GDP, the mostly is the consumption, not an investment, not a government spending, not a net export. The consumption is the mostly that contributes to the GDP growth in the United States. And we saw that the domestic credit is tiny contribution. But if you just replace that domestic credit with the consumption, see what happens. I don't know whether we have the consumption variable here. We have FDI, military expenditure, exports. I think the FDI, foreign direct investment, is investment, domestic credit to private sector. Anyway, they don't have it, but there's other proxy that can be used as a consumption and so on. Now, coefficient and the p-values are already stated. We have seen that p-value are less than 1% of significance level, so they are significant. The next thing that we need to look is R squared, okay? R squared is 83%. So which means %, variations in GDP can be explained
by variation in independent variables, and only 17% explained by other unobserved factors, other variables. Okay, once we have identified econometric model, once we have tested the significance level of the coefficients, okay. Secondly, we have created the hypothesis and we interpreted the R square, which is really very important because it measures the goodness of fit, like how your model is fitted. The higher the R square, the more it shows that it fitted to the model. Because the variable that you have selected, it really explains well your dependent variable. And the last final that you need to see is F statistics in here, which is probability of F statistics, which shows the validity of the whole model. It could be the case that econometric model here that we have it, the whole model should be tested for the validity, for the best fitness. One coefficient could be not significant, the other could be significant. This could be the case. And you have to decide whether the whole model is best fitted or not. To do that, we need to just see the probability of F statistics, which is 0 here. The logic stands similar to what we did it like when we tested the coefficients separately, individually, comparing with the p-values, 1, 5, 10%. Same thing here. P-values here, we can see it should be less than 1 or 5 or 10%. If it's less than 1 or 5 or 10, then it is significant. The whole model is best fitted. So we can rely on the whole model. So we can use this model as prediction model, how to improve the economic growth in the country. Okay, let me just summarize first of all what you need to do here to write it. First, you have to come up with the economic interpretation. Which means given the explanation how your GDP will change if 1% change in domestic credit increase or decrease, and keeping other factors fixed, ceteris and paribus, and explain each coefficient separately. Like equate the domestic credit and other factors to 0, what will happen to your GDP? GDP will grow by 11.65%. What if ceteris and paribus 1% increase in domestic credit? What will happen to your GDP? GDP will grow by 0.008%, and so on. So this is the economic interpretation. Second, you check the coefficient significance. Test for coefficient significance. By creating the hypothesis for each coefficient. We said you start with the null and alternative hypothesis, where like beta 0 not equal to 0 and so on. And then you go with you start with beta 0, okay? Then you continue with beta 1 coefficient. You check the significance level. Then the first we said we're going to deal with economic interpretation. Second, you're going to deal with significance level test of the coefficients. And the third is goodness of fit which is R square. Okay, you're using R here. You interpret like 83% changes in GDP can be explained by changes in independent variables, which are like domestic credit, and here is only case of the domestic credit. And of course, the final stage, what you do here, it's testing for validity of the whole model, okay? Whole model, validity of the whole model, where you create again like different hypotheses, null and alternative hypothesis, null and alternative hypothesis. In here you say that like beta 0 is equal to beta 1 and all equal to 0. But in here, sorry, I have to draw it like this. Beta 0 is not equal to 0. And beta 1 is not equal to 0. And this is how you test the validity of the whole model. If p-value, which is this, is less than 1 or 5 or 10%, then the whole model is best fitted. Then we just reject the null hypothesis, saying that the whole model is best fitted because p-value is less than 0.01, which is 1% of level significance. That shows that the model is best fitted. So we can rely on the whole model. The whole model is best fitted. This is how you explain a simple regression analysis. This is what the data you get it. Then we're going to deal with the multiple regression analysis, which I will start right after that if you will not have any question. But before moving to that, please feel free to ask any questions, any comments you want to make. So in the quiz, in the exam, I will give you the data, or I will ask you to download the data or prepare the data, run the regression analysis, and give the proper interpretation, like econometric interpretation and so on. Now, now you need to basically interpret, starting with econometric interpretation, test for significance level of each coefficient, goodness of fit, and validity of the whole model. But after final stages, when you will proceed to the more advanced techniques, where you will do the testing for different types of problems like multicollinearity, endogeneity, heteroscedasticity, stationarity, cross-section dependence, like this, you're going to do all these tests, whether this exists test or not. If there are problems are existing, what you should do something, so you will apply. But for this type of, the first exam and the quiz will include only this, just regression analysis. We will assume there are no any problems in the data. Simple, straightforward. There's a data, prepare the data, run the regression, get the results, interpret, and submit it. Okay, you have questions?
We're going to do only simple regression?
Yeah, multiple, yeah. Simple is this one, but I might ask you, please do the simple or multiple. I will give you the data, then you have to decide which one is simple, which one is multiple. So you have to know, maybe I'll ask you to do this time series. Or maybe I'm going to ask you to do the panel data analysis. If it's time series, then you have to select the data only, which is time series. If it's panel data, then you have to select which are panel data. You have to know, and you should be able to differentiate between the time series and panel data analysis. Okay. Do you have any other questions? Any comments? Okay. And by the way, I started to record everything. later I will share with you the link where you can just, if you will feel that you need to rewatch everything, you can rewatch it here. Okay, everything will be available. Yes, please.
For me, it's still is unclear when you say like the null hypothesis for the intercept is 0.
Yes.
Because we usually, I mean, can assume it can be 0. I mean, it doesn't matter how we started. I mean, for me, null hypothesis should be the one that we are dealing with slope, not the intercept.
No, intercept is important as well because we assume the assumption is that what if this slope does not have any impact? What will be then what will happen to your dependent variable? What will be the consequences on that? If the slope doesn't have any impact, this could be the case. This is just making assumption analysis.
But shift like doesn't matter like the intercept where you can anyway shift like you. The point is that how we have, I mean, what kind of slope we have, like positive, negative.
Yeah.
For me, intercept doesn't matter.
It's for you, but what if of the country? Imagine government does not do anything. That happened in the pandemic situation. Lock down the private sector, lock down the consumption. That's it. How your GDP will react on that? Will it grow? Will it fall? You never know. So to know it, to make a prediction on that, you have to know what is your intercept on this case. Intercept sometimes can have a negative impact. Sometimes can have a zero impact. Like, can you say that from here, without looking at the p-values, is it going to affect or not? Intercept.
For me, intercept, you can shift it to the minus side, but it's like a.
How can you shift it to the minus? For example, in here it's a positive. How can you shift it to the minus side?
It's how you interpret data. I mean, when you can say it like, let's assume it's 0, and you can more.
No, in here we are based on the statistics. We are based on the statistic that we got. And it shows mathematically calculation. If you're more concerned how to calculate, how did they calculate it? Because I'm not here to teach you how to get these concepts, intercept. If you're more interested to see how these numbers are derived, like how the Stata calculates, the book, the building that are attached there, it explains like step by step all the calculations. I was planning to show it, but it's gonna complicate the issue because not everyone has got the mathematical background here. And shifting left or right, the intercept to the positive, negative, doesn't make sense when it comes to the econometric analysis, because econometric analysis, it's not, as I told you last time, it's not the concrete science. And the result we get it here is based on the correlation between the intercept and the GDP. In some countries, the correlation can be negative. Like, if you don't do anything in the country, your GDP will just pump down. But in other countries, like in the United States, the example is given here, GDP grows by itself. You don't do anything, just leave the economy, close down for 1 year, and you will see the GDP will still grow. But other countries like developing countries or underdeveloping countries, it's not the case. And the science has already proven. How do they prove it? Through the econometrical analysis, using like intercept and so on. Again, if you're more interested in how these numbers are derived, like to get more sense of it, then please feel free to go for the book itself. And here we need to check the significance, because we need to understand whether the whole model is best fit, whether the whole model can be reliable. Can we use, because once you have written this econometric model, it does not necessarily mean that you can rely on the model. You have to perform and you have to create the hypothesis to understand whether the model is best fitted. And before coming to the whole model best fitness, you have to check each coefficient individually. And another thing that I can add it here. We are not here only including the beta 1, okay? We may include beta 2, beta 3, beta 4, beta 5, and beta 6, and beta 7, like up to beta infinite. But the only thing that you should remember, this coefficient should be always here, beta 0, which is intercept. It must be here. There is no any other intercept except this one. But the slopes are coefficients which are here. It could be this domestic credit, but it's not limited to only this domestic credit. They have other things too. Okay. In multiple regression analysis, it's similar to this, but the only thing that we are adding more variables of independent, like more coefficients will be added, like our model will be a bit expanded, like depending on how many variables we are running. In this case, we have, let's say we want to see GDP is as a dependent variable and domestic credit as independent variable, and we want to add one more variable here. Let me add it like military expenditure as government expenditure, and I can add it exports. Like 3 components of the GDP are here. And by the way, one more thing I want to tell you that before moving here, as you can see, the R squared is 83% with only just one independent variable. By adding one more independent variable or 2 or 3, increasing the number of independent variables, the R squared are expected to increase. What did we say about the R squared? R squared shows by how much your GDP will change or by how much your dependent variable changes, which are measured by the changes of independent variables. As you use more independent variables, that shows by how much it will increase your GDP, that the capacity and changes will be impacted as well, that will increase as well. And as an example, we added like 2 more variables like government expenditures and net export. And we can see here what happened to your model. Here we go. Now, if you look here, look at the R square. It increased. It became like 86%. It was 83, now it's 86, because we added domestic credit, military expenditure, and export. But let us go through the coefficients are here that we have it. Again, you start your interpretation with the econometric model. You have to create the econometric model. Your econometric model as follows. GDP is equal to beta 0, which is intercept. We can put directly the number. The intercept in here is 12.35 plus domestic credit. And you can see domestic credit is improved a bit, 0.004 of domestic credit. Then we can add the military expenditure. But military expenditure, if you look to the coefficient, is minus negative. So we need to put minus, which is 0.063 of military expenditure. I'll abbreviate like this. Then we use Export. Export, we can see it's a positively related. So it's basically plus 1.7% of exports. And of course, plus error term, unobserved factors that we have it here. So this is econometric model. First, you have created the econometric model. In your thesis, whenever you write any thesis, econometric model is must in methodology part. You create first econometric model, then you come up with the other stuff. And once you created your econometric model, you need to make the econometrical interpretation, taking into account like ceteris and paribus, like keeping all other things unchanged. Like, though we have added 3 variables here, okay, we added 3 variables here, military expenditure, we added export, we added domestic credit. And still it is not limited to this. There are some other factors that can affect the GDP. Those factors could be the tax policy. Another factor could be foreign exchange. Another factor could be interest rate. How the interest rate do you think will affect the GDP? If interest rate increases, what happens to GDP? Like theory, in theory.
To go down.
It go down because why?
Because credit is.
So the interest, it's a measure of cost of borrowing. As you increase the cost of borrowing, GDP grows down. So though if you include even the interest here, include other inflation, let's say inflation and other factors, still there will be some unobserved variables that you did not include. You cannot include all variables here. You can include up to certain levels, okay, that you think that they are mainly represents your some proxy that you have selected. Okay, military expenditure, export, domestic credit, we found it. And we said that unobserved heterogeneity or unobserved factors exist too. Now we can see the economic interpretation by ceteris and paribus, like if the government does not do anything, just leaves the economy untouched, leaves the economy like without making any intervention, the GDP will grow by itself by 12%. If other factors kept constant and domestic credit increased just by 1%, GDP will grow by 0.004%. However, if the government decides to go into another war, okay, to maybe with another country, and they need to increase the military expenditure by 1%, your GDP will go down. So we can see the military expenditure has got a negative impact. On the other side, if the government tried to boost up the export, okay, maybe it reduces the taxes, maybe it promotes other stimulus for those companies that they do exporting to other countries, that will 1% increase in the export ceteris and paribus, 1.7% will have an impact on the GDP. Your GDP will increase by 1.7%. And we can see the significance, okay, here. Domestic credit is significant because it is less than 1%. Military expenditure, less than 1 or more than 1? Be careful. More than 1, but less than 5. So military expenditure coefficient, which is -1, it's moderately significant, not highly. If you compare with the domestic credit, which is highly significant, but military expenditure coefficient is moderately significant. So the probability of the impact of this coefficient is moderate, okay? You cannot predict for like highly frequency, for highly probability in terms of like prediction. If you compare with the domestic credit, like with the domestic credit, you can say like for sure that domestic credit will have an impact, but that impact will be tiny. Military expenditure has a impact, but that impact is moderately significant. Expenditure, the exports,
also moderately, okay? And it could be the case, it is more than 5, more than 1, but it's less than 10. Which means if it's less than 10, it is weakly significant, okay? Like it has a weak significance, which means, however, it has a substantial impact, but with a weak significance. I mean, the level of the prediction is low. Less than 10. Oh, sorry, less than 5. Sorry, less than 10, more than 5, more than 1. And still we reject the null hypothesis at 10% of level significant. And now we can see like 2 of them weakly or like moderately significant. One of them highly significant. This is highly significant too, the constant variable. And it shows that the model could be tested for the best fitness, for the validity, and we can refer to the probability of F statistics. And by the way, F statistics as well is used in when you evaluate the performance and the volatility in the stocks. Like specifically, there's some comments are given to test which stock or which indices are more volatile. That will show, gives you with statistics using the F statistics, which we'll touch a bit later when we will proceed for further research and further techniques. But up to this point, we can see the whole model is best fitted. So this whole model is best fitted. Why? Because the probability of F statistics is less than 1%, and it's highly significant. And if we talk about the R square, we can see that R square is 86%. So variation, 86% of variation in GDP can be explained by the variation in domestic credit, military expenditure, and exports by 86%. And 14% is explained by unobserved variables, which could be inflation, interest rate, government policies, political stability, ESG policy, and so forth. Okay, any other question? Do you have any questions here? So with econometrical interpretation, you understood, yeah? How to work out and how to do this. And now what I can just illustrate to you, let's say we have collected, so far we collected the country-based data, okay? There is a data type like firm-specific data. When you download the data based on the firms, individuals, okay? Then how you can combine country-based and the firm-based data together. There's a way to combine it if you're going to come up with a, let's say, panel data type of analysis. We know how to create the time series, we know how to create the panel data, but how to join different firm-based and the country-based data. Like we have firm-specific variables and we have country or macroeconomic specific variables. Let me just illustrate to you too. I will go here again. These are data, okay? Here, for example, I have put data set that I have downloaded from Bank Focus, okay, for 9 countries, Christmas countries, okay, Christmas plus 3 countries. There are 9 countries, more than 400 banks, okay, they're here, but they are not organized. Let's say you want to select these 10 banks. So these 10 banks, there are many variables actually for many years. So you have to work out this. This file is located in L drive and in folder which is called data. So we have here more than even, I was thinking it's 400, no, it's more than even 400.
What is the name?
The name is Christmas. It's called Christmas plus 3.
Bismuth refers like it's a classification by Ernst and Young. It's a Qatar, Indonesia, Saudi Arabia, Malaysia, United Arab Emirates, Turkey, Bahrain, Kuwait, and Pakistan. Like 9 countries. They have classified like highly emerging, growing countries. So I'm going to use this data set. Let's say I'm going to select 10 banks here, copy. Paste it here. So now I have to make them in a way that it will be panel data, okay? But panel data, it's a kind of block system, okay? You have to create different blocks for each company. First of all, I will organize it in a way that what type of data I have it here. 2022, 2021, 2021. It's like semi-annual data, actually. It's a semi-annual data. By the way, you see this NA here, it's not available, which means whenever you're going to put it in the Stata, make sure you just delete these things. You don't have it in your Excel. Otherwise, your Stata will not run. Your Stata will recognize it as string variable. Yeah, you delete in Excel, then just put it there. I choose the first 10 banks. And regarding I'm just trying to get not all the variables, I'll select just some of them. Just one variable.
I mean, when you copy paste, you use transfer.
No, just copy and paste. Just copy and paste. Just get from there. The issue here that I downloaded like semi-annually, which is really not good. Because playing with the data, let me just, okay, here. I'm trying to get rid of the variable that I don't need it actually. Here, I think this is the, okay.
Maybe it's better to find the right data.
To find the what?
Right data.
No, what do you mean? No, I mean it's a right data, but it's a semi-annual data. It's a right data, but it will take the time to work out with this. Like, yeah, let's find the. I think we should have it here. If I go to past.
But I mean, because you selected 10 first 10 rows, and then in the future it may need other banks, and then you need a copy and then you delete it.
Is for here quantitative analysis data. Let me go with this, for example. Okay, this is like I organized it. Let's say. So I will put it again back. This data, I will copy it. You can have it there. You can download it. In full, like in our date currently. I'll put it here. So whenever you will be downloading data, data will not be appeared in this way, okay, in this format. This is the format that you have to come up with. It's here. All bank 321, Christmas plus 3 countries. It's like fall 2023 quantitative analysis data. It's there now. Yeah. So in here, you have to organize in a way as a block, okay? It will be given as a block to you. For example, first ID, and you put the company name and put the years, okay? If it's like from 2006, 2015. This is first company. And then put the relevant variable like return on asset, return on equity, net interest margin, whatever is given. You just put it here. Then return on assets, net interest margin. Let's say I'm gonna just select first 3 banks here with the 3 variables. I select it, copy it, and I'm gonna put it here. Okay. Now it's here. Let's say you organize it, but not the data is not available in this format. As I'm telling you again, I'm repeating it because you need to organize in your own. So let's say I'm going to add it here, the GDP. I want to add the GDP here. GDP for which country? For Bahrain. You know, it could be the case. This is the Bahrain, but another company is Qatar, okay? So you're gonna, and we have, let's say, not only the Qatar, and we have, let's say, here Turkey. So we have different 3 countries and different 3 companies. Now we're gonna have macroeconomic data, which is for 3 countries. So you need to download the macroeconomic data for 3 countries, Bahrain, Qatar, and Turkey. And then you're gonna put it accordingly. So GDP, it could be, nowadays it's very popular to use ESG policy, like environmental, social, and governance. Like environmental, it's like CO2 emissions. Governance are control of corruption, political stability, and social. There are other some factors that like proxy for the social responsibleness. So you can put those variables too. But let us just limit ourselves to GDP today. So we're gonna just use the GDP here. So in here, I go to data bank, like databases that I'm using here, world development indicators. Let me just go with the database change. I will select like financial development database. I will select the Bahrain. Qatar. And Turkey. For the series, I need only GDP. Gross. Do I have it here in this database? I think I don't have it. Anyway, let me select the stock market capitalization, okay? The financial market. It's a macro data as well. I will select this one. Like how the financial market has got the impact on other variables. And I'm gonna select for how many years? I need to select from until 2015. Okay, I have 2015 data from 2006 to 2015. So this, 2006, 2015. Apply changes. Download options, Excel. Okay, this is the data we got it. We can see from 2006 here for Bahrain, okay? I get this data. Bless you. Copy it. And transpose it. This is for Bahrain. Then I go for R1. This is for Qatar. Expose. Put it here. And I've got the last one, Turkey. We can see that Turkey has got all the data from 2006 to 2015. And I transpose it here. That's it. So my macro and firm specific data combined. And it should be combined in this way. Like with the blocks. ID first of the first company, country, and by years. And of course, as I told you, if there are some like letters that are not really readable by the Stata that you need to delete, you can delete like with the Control F with the replace button. Okay, just copy this and paste it here and leave this empty and put like replace all. So it replaced all the 7 cells. So all the dots have been removed here. So I don't have any buttons that I will not use it. And the only thing that the problem in here, you can see the GDP. So it was a stock market capitalization, okay? Stock market. Here we can see that there is a problem. My ROE, ROA, and the net interest margin are in decimals. Though it represents the percentage, but they're written as decimals. Either I have to change this decimal into percentage or convert this percentage into decimals. How we do it? Not logarithm, but we just, divide by 100. We divide by 100. It's a percentage. It's not the actual number. You don't have to take the logarithm. It's better to make it by 100. Okay. Stock market. Percentage. So our data is ready here. Now I can save it on my desktop. So this is how you unite some other variables. You can put here like control of corruption. You can put the political stability and ESG, other macroeconomic variables. So your research, if it's panel data, it's always divided into 2: firm specific and macro data. And you need to know how to combine those things. Once you are able to combine it, that's it. Like everything here. Now we can just go file, import, Excel spreadsheet. It's here. And we can select the right worksheet. Yes, this is the worksheet that we have created. You put it here and you go to statistics, longitudinal data, panel data, not the time series, but the panel data. Set up utilities, declare data set to be panel data. Panel ID variable, it's ID that we have created. And time variable is years that we use, and it's a yearly basis. Just press OK. That's it, strongly balanced.
Do we need to like? We combine countries?
Combine countries, firms. That's it. So this is information for you to know when you're going to collect the data for your thesis. Because you're going to collect the companies. Maybe you're going to not limit yourself to one country, you're going to collect on several countries, comparison. If you're like supervisor, going to tell you, please do the like select 5 countries, and from each country select like 10 companies. And this all data are available in data stream, like companies, where you can collect the company's data. Like the one that we have it's icon, which one I'm going to show you as well, how to use it. That database you can use it as well. Apart from that, you can download it from any like data open sources like Yahoo Finance, any stock exchange market like CASE, IX, they have all the financial information about the companies. But the most really good ones are Bloomberg, Icon, Orbis. They're really more organized one. It gives you in a way you want. But when you collect from the CASE, you have to on your own drag the numbers and put it in Excel like one by one. Copy paste, copy paste. You cannot just copy as a whole and put it there as it gives here. Yeah. Do you have any questions? Okay. Let me take attendance.